Greetings. This is Trading-Lesson31, delivered by Twigbe Eizugi. It's for Forex traders, cryptos, currency traders, stock traders, option traders, and other chart-related traders. You're advised to subscribe, share, likes, and make comments. You can contact us for account management, training, consultation on +234 803 759 7085. When the market is in a trading range, traders should be guided by the maxim: buy low, sell high. Also, think of your trade as scalps and not swings. Plan to take small profits and do not hold on, hoping for a breakout. The rallies to the top usually look like they will become successful breakouts into a bull trend, but 80% of them fail, and 80% of the strong sell-off to the bottom of the range fail to break out into a bear trend. Try to keep your potential reward at least as large as your risk, so your winning percentage does not have to be 70% or higher. Since market is two-sided, there will often be pullbacks after you enter and before you exit. So do not take a trade if you are willing to see through a pullback. The mathematicians do not need to even look at a chart. They design programs to capitalize on small movements, and a tight trading range looks like a perfect environment for a smart programmer. The math is against a trader entering and exiting on stops in a tight trading range. Entering and exiting on stop in a tight trading range is a losing strategy, since you cannot profitably scalp for 1 to 3 ticks in a tight trading range the way the high-frequency trading firms are doing. You have to wait. If the barbed wire develops in a pullback to the moving average, stay mostly on the with trend side of the moving average. It is just part of the pullback, and there will usually be a with trend breakout. However, if the pullback goes through the moving average and then the barbed wire forms mostly on the opposite side of the moving average, this pullback has enough strength so that either a second leg is likely, or you missed the chart and the trend might have already reversed. One very good rule is that if there is a trading range setting up and it is near the moving average, never look to buy if the bars are mostly below the moving average, and never look to sell if the bars are mostly above the moving average. This one rule will save you an enormous amount of money over the years. Overlapping bars at the moving average create a dangerous situation. Anyone blindly doubling up after consecutive losers is gambling and not trading, and gambling is entertainment, which always involves a fee. In general, all tight trading ranges are continuation patterns. An IOI pattern is often a reliable breakout setup. Triangles are trading ranges and therefore channels, since they are an area of price action contained between two lines. The minimum requirement for a trading range to be called a triangle is that it has 3 pushes up or down, since they have either higher lows or lower highs, or both in the case of an expanding triangle. They also have some trending behavior. Wedges are triangles that are either rising or falling. When they are just barely sloped, traders refer to them as triangles. But when the slopes is greater, we usually call them wedges. A bull or bear flag can be a wedge, and we usually just become a continuation pattern.